Now, someone with me today, a good mate of mine, who also started his business exactly the same year as us, in the studio with us, is Plan 4 Financial Services Managing Director, Phil Ely. How are you, Phil?
Good, Anthony. Good to see you again, mate.
Nickname Popeye?
Oh, well, yeah. From many trips on the motorbikes together, so we all have a nickname ticker.
And now, Phil, just to give us a bit of background for people who are not aware, you're a financial planner. You've been in the business for a long time, obviously, and just perhaps give us a rundown on your history.
We started 27 years ago, and then Anthony, you and I were on the stage at a conference in our industry, I think 25 years ago now, which goes pretty quickly. Look, we've been operating in South Australia, started a small business like yourself, and over the years have just studied and became more accredited in what we do, Diploma of Financial Planning, Fellow of the Financial Planning Association, so we're quite involved in the industry. Have a long history with our clients. We manage probably a couple of $100 million in various stages. That could be mums and dads, it could be corporates. We do a lot of corporate superannuation. So it's a great job. It's a diverse profession, and we just enjoy helping people, basically.
Now, Phil, a lot of people wouldn't necessarily know, and it's so basic to you, but when would you get a financial planner, and what does it cost?
Well, it varies. I guess it's a bit like commissions on real estate, but the issue, I think, financial planning, really there's two components of financial planning. One is investing money, and for those people who have accumulated money, they need advice on how best to structure that in a way that probably avoids making bad decisions. And the other one is planning for the future in terms of trying to get a handle around what sort of things should you be doing now to make things better for you down the track. And so that sort of planning process requires speaking to a professional like a certified financial planner, and they can help you understand the pitfalls and put you on a roadmap towards future security.
Now, the cost?
Well, the cost varies. I mean, typically, if a client is referred to us, we have a cost for the first interview. That includes an hour of time, it includes minutes and strategies. And then if they wish to go forward from that and have a financial plan, we charge for our time. And if they then decide to proceed with that, we give a rebate, so we have an incentive for them to do business with us. But generally, you could be looking at a couple of $1,000s for a plan, discounted. From there, if you go ahead, and then you have a long-term relationship with people in terms of managing their funds. So it's horses for courses, really.
Now, we had a budget that you would have been really interested in that came down last night.
Yep.
Like watching wallpaper dry or something. But on a serious note, anything in there that's of any great interest to you or property owners?
Well, there's two components of the budget. I think one is a social component, which is obviously helping out those people who are less fortunate, and there's certainly a component of distributing wealth to those who are less fortunate in many ways. The second issue relates to businesses. There are some components in the budget in relation to bringing forward previous tax losses against past earnings rather than future earnings, so that will have some impact. And there's also immediate write-offs for purchases up to $6,500, so that'll give some depreciation benefits or tax deduction benefits. The other issue relates to superannuation. I think they're playing around with superannuation a bit. Certainly those people that need to or can afford to put significant amounts into super are going to find it a little bit harder with the contribution caps coming down. And those people who are at the upper end will find themselves hit with a further 15% tax on their contributions. So.
When does all that kick in? Is that from now? From today?
Well, some of it will be immediate. There's a delay of increasing contribution caps by 2 years. So those people that were expecting to be able to lift their contributions or remain at a level of 50,000, that's going to be held back now for 2 years. So they will have a reduced contribution for 2 years and then gradually come back up. So yeah, some things are immediate and some things are deferred.
Now, Phil, there's been a massive amount of discussion with the rate dropping 0.5% last week. This week, the budget. We're in the property sector. Tell me what you're thinking globally, how confident your clients are or how confident you are in the economies, and how that all impacts on property owners from your perspective as a planner.
Well, I guess, the rate rise, it's interesting now that the federal government or the RBA is building in a margin for the banks, understanding they're passing on 0.5%, but knowing that that's not going to reach the hip pockets of ordinary mortgagees. So that's a little bit of difference. And I think, being in surplus, it's going to give this government will give the RBA an opportunity to more tightly regulate the cash rate. So that probably spells good news for mortgagees. You could look forward to seeing maybe some more easing, which will make those mortgages a bit cheaper and obviously stimulate the property sector.
Now, in terms of advice to your friends and family, and given that you're not a property man, how do you rate property versus shares versus equities and cash, and what's your personal view, and what would you say over a dinner table to friends?
I think there's a difference. There are lifestyle assets. I mean, I've owned 3 or 4 family homes. I never owned any of them with a view to making money. That's how I live. I've got a beachside property, which obviously is an investment, but it's a lifestyle choice. But conversely, we've just bought our own business office and fitted it out. That was a business decision, done tax effectively. We're getting a high yield out of that. So there's a mixture of lifestyle and growth assets. So there needs to be a balance between having liquidity so that you've got cash flow coming to you to support your income and especially in retirement, and also other assets that can grow over time. Now, property has proved to be one of those gems in that market. When there's a purple patch like we've just been through, property grows at a significant level. So they're very important assets to have within a portfolio. But the overriding message from me is diversify.
Okay.
Some cash, some property, some shares, a bit of everything in the basket.
So in terms of residential property, which is the segment that we're really focused on, would you at the moment say to a client that walked into your door, look, I think you need an investment house, or would you say, no, let's put that into shares right now?
I don't think we've got a view one way or the other. From our perspective, it's easier for us to deal with property from the point of view of using property units in managed funds. So we can isolate retail, commercial, industrial, global, Australian property within a portfolio. But if we've got a client that has a bent towards owning and being able to see and feel and touch, we'd rather refer them to somebody like you, who have an expertise in that area, than pretend to be experts ourselves. Right.
So as a person, I know that you've been hugely successful, so congratulations on that in your own business and your own success. So as a person that's in that space, you've proven that you've got what it takes. You've been through the really tough period and come out of that really well. What would be 3 tips for people, for their future security that you've followed and that you really have stood you well?
Okay. Well, I think managing your debt levels. So from a business perspective, we always try to operate in the black. So we haven't gone out heavily and borrowed. From a business perspective, that's not to say we haven't borrowed for investing. Certainly spreading your eggs and having a cross-section of investments. And really, I think the overriding thing from a business perspective is that we've just tried to build strong, solid relationships with people that have meaning. Money happens to be part of it, but it's actually not all about the money.
So it's the character of the people as well?
Well, it is. We have great relationships with people, and if you maintain those for long terms, like 25 years plus, you must be doing something right.
Phil, great advice. We're going to come back with a question a bit later in the show.
Sure.
Now let's go and look at some sold properties, and it's gone.